So as we continue on with our PowerPoint, let's talk about product financing arrangements. There are companies out there that have a manner in which they try to finance their inventory. And in this way, one company might sell the inventory to a company that's the financing company. And then the seller agrees to purchase the inventory or some type of specific similar items backed from the financier at specified prices over specified periods. So that can happen. It's a manner in which they're financing their assets. Now, various quantities of inventory. How do companies determine these quantities? Sometimes they will create something called a bill and hold sale. Basically, the company purchases inventory but isn't ready to take delivery for certain reasons. They might not have enough space, or based on their production, they're not ready for that production at that time. So the buyer can ask the seller hold the goods and have those goods delivered at a later date. In this case, then those goods really should be in the inventory of the seller, and a sale should not yet be recognized until they deliver those goods. There are sometimes what we know as purchase obligations. So sometimes companies enter into agreements with sellers so that they have planned they're going to purchase so much inventory, and the inventory has been set within a contract, and even though they've agreed to purchase inventory, they have not actually received those products at the time. Basically, recording an asset or showing a purchase obligation is not necessary just because they've placed an order. So know with GAAP, it's not required to record that asset or to record a liability when they've entered into that commitment. So purchase obligations really are not going to even be affected in the financial statements until that inventory is delivered. If companies have incurred what we call unconditional obligations at a fixed price, or sometimes it can be a price to be determined, that might be a note that is disclosed in the financial statements for full disclosure, but it would not affect the financial statements. Here's an example with Morgan Company entering into a non-cancelable commitment to purchase inventory at a fixed price of $500,000. The market price for the same inventory at the end of the year is down at $450,000. So they would make a year-end adjustment as a result of the lower of cost or market here. So we would show a loss on purchase commitments of 50, and then we would be crediting an accrued loss on purchase commitments. The reason we're doing this is that the fair market value has decreased from when we entered into that commitment. Morgan reports an accrued loss as a contingent liability on its year-end balance sheet. It writes off the accrued loss when it purchases the goods. So we will show the purchase of the goods at the true lower of cost or market, $450. We would then debit our accrued loss on the purchase commitment, and we would then credit our payable. Now, if the market price rises, it would then reduce that accrued loss and recognize what we would call a loss recovery. Product costs are what is transferred for consideration. So inventory costs are going to include what we purchased those products for and any other cost to get them in a condition that's available for sale. Period costs are generally costs as it relates to running the company. Selling costs, it's important to note, are also a part of period cost. Period costs get expensed because really that is just the normal course of operations. They do not directly or indirectly deal with inventory and get it ready for sale. Product costs are going to be put on the balance sheet as a current asset until they are sold. Now we know purchase discounts will reduce the inventory cost of those goods. We've got different methods, and we're going to talk about the gross price method, where in this method, what will happen is the company is going to show the purchase at the gross price and also shows and records an amount of the discount only if the discount is taken. This discount should be deducted from the purchase price of the inventory. So the gross price method is showing the full price, and then if the price is reduced because they take the discount, then at that time they show that method. We're not going to talk about the net price method. And then as we talk about purchase discounts, we're showing here the various methods of how purchase discounts are shown. So in this case, Lahiri purchases $1,000 of goods, 110 net 30. And if they pay for those goods within 10 days, they get a 1% discount. So in that case, we would show purchase of 1,000, credit our accounts payable, and then we would show when we pay it. If we have taken that discount, we would debit our accounts payable, credit our purchase discounts, and credit our cash. If we did not take advantage of the discount, then we would just debit our accounts payable and then credit cash. So I'm not going to focus on the net price method, but let's now talk about cost flow assumptions. Again, cost flow isn't related to the goods flow. This relates specifically to how we account for them on the financial statements. The two methods that are common, FIFO and LIFO. FIFO holding the major way in which most companies do show inventory. Average cost is another method that we will talk about. And then there's also specific identification too. So we know with units where chances are we're going to always try to sell the oldest units in our inventory. But for cost purposes, we are going to have a different method than we may with goods in order to account for that value on the income statement and that value on the balance sheet. Remember that cost of goods sold would be shown as an expense on the income statement, and then our cost of the ending inventory is a current asset on the balance sheet. So here's an example of how flows work with cost. We started the period on April 1st with 100 units at $10 a unit. Then on April 10th, we purchased 80 units at $11 a unit. And then again on April 20th, we made another purchase of 70 units at 12 units. So all the units that we have available for sale are 250 units at a total cost of $27.20. Now, we sold on April 18th 90 units, and then we also sold 50 more units on April 27th. So we show a total of 250 units available. We can see here that we sold 140 of them, and we have 110 units left in our April 30th inventory. We're going to show for this example that $20 is what we sold for all units. So no matter how we determine the cost flow, we are going to show our sales revenue to be $2,800. When we're dealing with what we call specific identification, we will specifically identify the units that were sold, and then those units that weren't sold will specifically be shown in our ending inventory. So if this company specifically identifies those units that were sold, then we can really come up with the actual cost of those units sold. If the units that were purchased on April 10th or April 20th are those that Dalton sold, then we would show the specific cost based on what we purchased those units for on April 10th or on April 20th. So under specific identification, the company would have to show specifically which were sold, and then from there we would know specifically what's left in ending inventory. As we deal with the method FIFO, the concept here is that the costs are going to flow in the order of first in, first out. So the first items are going to be the first that are sold. So the ones that are ending will be the ones that the oldest ones will be the ones we will show in our ending inventory. So as you see, the earlier costs are going to be the ones that we show under cost of goods sold. The later costs will be the ones that we show sitting in ending inventory in current assets. So as you see here, on April 10th, we had 40 units at 11. April 20th, we had 70 units at 12. We would show those 110 units as our ending inventory. We would show the cost of goods sold to be those items that we started our inventory with, plus the purchases from our April 10th of the April 10th that we would show that were in the earlier portion of goods. We would show those to be sold also. So when we deal with FIFO, first in, first out, we see we had a beginning inventory of 100 units. On April 10th, we purchased 1,000 units at $10 a unit. Then we also had 80 units at $11 a unit. Then on the 18th, we sold 90 units. So we can show that we sold those 90 units from our beginning inventory. And then from there, let me see here what I'm saying wrong here. Sale of first in, first out perpetual. Okay, so basically in the perpetual method, we're going to constantly keep track of our inventory. So we will show the sale of 90 units based on the $10 a unit. And it shows that we have left 10 units from our beginning inventory, and then we have 80 units from the purchase on April 10th. So I was wrong there. The April 10th purchase was of just 80 units at $11, and what they're doing here is carrying forward the beginning inventory so we can always have an accurate description of what our costs are. So we see what we have left in our inventory on April 10th. We've got 10 units left at $10 a unit. We have 80 units left at $11 a unit. So then when we go and sell 90 units on April 18th, we're going to basically get rid of the rest of our inventory. We've got 10 units from